Welcome to Stock Wisely, the channel where we help you make informed decisions about investing in the stock market. In this video, we'll be discussing the top 3 best strategies to make money in the stock market. Strategy number 1. Value investing. Value investing is a long-term investment strategy that involves identifying undervalued stocks and buying them with the expectation that their true value will be recognized by the market in the future. The strategy was popularized by Benjamin Grahamm, who is widely regarded as the father of value investing. At its core, value investing is based on the belief that the market sometimes misprices stocks due to short-term factors such as market fluctuations or investor sentiment. This mispricing creates an opportunity for value investors to buy stocks at a discount to their intrinsic value, or the value that the company would be worth if all its assets were liquidated. To identify undervalued stocks, value investors typically use fundamental analysis, which involves examining a company's financial statements, management team, competitive position in its industry, and other factors that can affect its long-term prospects. Value investors look for companies with strong fundamentals, such as a solid balance sheet, consistent earnings growth, a sustainable competitive advantage, and an experienced management team. Once undervalued stocks are identified, value investors typically buy them and hold them for the long term, sometimes for several years. The goal is to wait for the market to recognize the true value of the stock and the price to rise accordingly, allowing the investor to earn a profit. One key aspect of value investing is the margin of safety, which is the difference between the market price of a stock and its intrinsic value. A value investor seeks to buy a stock with a significant margin of safety to minimize the downside risk in case the market does not recognize the true value of the stock. In other words, the margin of safety acts as a cushion against the risk of losing money. Value investing is not without risks. One of the main risks is that the market may not recognize the true value of the stock, causing the investor to hold onto the stock for longer than expected. Additionally, if the company's fundamentals deteriorate or market conditions change, the investor may need to sell the stock at a loss. To take advantage of value investing, here are some steps you can follow for more understanding. Identify undervalued stocks. The first step is to identify stocks that are undervalued by the market. This can be done by using fundamental analysis to assess a company's financial health, competitive position, and growth prospects. Look for stocks that have strong fundamentals but are trading at a discount to their intrinsic value. Conduct a thorough analysis. Once you have identified potential stocks, conduct a thorough analysis to ensure that they meet your investment criteria. This may include analyzing the company's financial statements, assessing its competitive position, and evaluating its management team. Determine the margin of safety. To minimize your risk, determine the margin of safety for each stock you are considering. This is the difference between the current market price of the stock and its intrinsic value. Look for stocks with a significant margin of safety to reduce your downside risk. Buy and hold for the long term. Value investing is a long-term strategy, so be prepared to hold onto your stocks for several years. Do not be swayed by short-term market fluctuations or fluctuations in the stock's price. Remember, the goal is to wait for the market to recognize the true value of the stock, which may take time. Monitor your investments. Once you have invested in a stock, monitor it regularly to ensure that the company's fundamentals remain strong. Keep an eye on any changes in the company's financial health, management team, or competitive position that could impact its long-term growth prospects. Be patient. Value investing requires patience and discipline. Do not be swayed by market trends or short-term news. Stick to your investment criteria and wait for the market to recognize the true value of your investments. Strategy number 2. Growth investing. The second strategy to make money in the stock market is growth investing. Growth investing is a strategy that involves investing in companies that are expected to grow at a faster rate than the overall market. The primary goal of growth investing is to achieve capital appreciation, or an increase in the value of the investment over time. The growth investing strategy is based on the belief that companies with strong growth prospects will deliver better returns to investors than companies with slower growth rates. The rationale is that companies with high growth rates will be able to increase their earnings and cash flow over time, which will translate into higher stock prices. To identify companies with high growth potential, growth investors typically look for companies with strong fundamentals, including a sustainable competitive advantage, a proven track record of growth, and a solid management team. They also look for companies that are operating in industries with strong growth prospects, such as technology, healthcare, and consumer discretionary. Once potential growth companies are identified, Growth investors typically buy their stocks and hold onto them for the long term. They do not typically focus on short-term fluctuations in the stock price, but instead look for companies with strong long-term growth prospects. One key aspect of growth investing is the willingness to pay a premium for high-growth companies. Since growth companies are expected to deliver higher returns in the future, investors are often willing to pay a higher price for their stocks compared to companies with slower growth rates. This can make growth investing a more expensive strategy than value investing. Growth investing is not without risks. One of the main risks is that growth companies may not meet the market's high growth expectations, causing their stock prices to decline. Additionally, since growth companies often operate in industries with high competition, they may face challenges in maintaining their competitive advantage over time. The key differences between growth investing and value investing are the types of companies you are looking for and the investment criteria you use to evaluate those companies. In growth investing, you are looking for companies with high growth potential, while in value investing, you are looking for companies that are undervalued by the market. To make money with growth investing, it is important to identify high growth companies, conduct a thorough analysis, invest for the long term, diversify your portfolio, monitor your investments, and be patient. By following these steps, you can potentially earn a profit over the long term by investing in companies with strong growth prospects. We discover the top 10 companies carefully researched and selected by Stock Wisely, exclusively for you. Invest wisely and stay ahead of the game with Stock Wisely. For value investing: AT&T Inc., Johnson & Johnson, Walmart Inc., Intel Corporation, Ford Motor Company. For growth investing: Amazon.com, Inc., Facebook, Inc., Alphabet Inc., Netflix, Inc., Shopify Inc. It's important to note that this list is not exhaustive, and you should conduct your own research and analysis before making any investment decisions. Also, keep in mind that the suitability of these companies for either strategy may change over time as market conditions and the performance of the companies themselves evolve. Strategy number 3. Dividend investing. Dividend investing is a strategy that involves investing in companies that pay dividends to their shareholders. Dividends are regular payments that companies make to their shareholders as a way of sharing their profits. Dividend investors typically look for companies that have a history of paying consistent and increasing dividends, as well as a strong financial position. By investing in dividend stocks, investors can earn a regular income stream from their investments, while also benefiting from any potential capital appreciation. Dividend investing is a strategy where investors buy stocks that pay regular dividends to their shareholders. A dividend is a distribution of a portion of a company's earnings to its shareholders. Dividends are usually paid quarterly, but some companies may pay them monthly or annually. The main goal of dividend investing is to earn regular income from the dividends paid by the companies in which you invest. This is a good strategy for investors who are looking for a stable source of income from their investments, especially in times when interest rates are low. Here are some key steps to follow if you are interested in pursuing a dividend investing strategy. Identify dividend-paying companies. Start by identifying companies that pay dividends. You can use financial websites or stock screeners to find companies that pay regular dividends. Analyze dividend-paying companies. Once you have identified potential dividend-paying companies, conduct a thorough analysis to ensure that they meet your investment criteria. Look at the company's financial statements, competitive position, management team, and dividend history. Assess any risks and uncertainties that could impact the company's ability to continue paying dividends in the future. Look for dividend growth. Look for companies that have a history of increasing their dividend payouts over time. This is a good indicator that the company has a strong financial position and is committed to returning value to its shareholders. Consider dividend yield. The dividend yield is the amount of dividends paid by a company relative to its share price. Look for companies with a high dividend yield, but be careful not to focus solely on yield, as high yield can be a sign of risk. Diversify your portfolio. Diversification is key to reducing risk in dividend investing. Invest in a portfolio of dividend-paying companies across different industries to spread your risk. Monitor your investments. Keep an eye on the companies you have invested in and monitor their financial health, dividend history, and competitive position. Regularly review your portfolio and make any necessary adjustments. So those are the top 3 best strategies to make money in the stock market: value investing, growth investing, and dividend investing. Each strategy has its own benefits and risks, and it's important to do your own research and understand your investment goals before choosing a strategy. Remember, investing in the stock market involves risk, so always invest with caution and seek professional advice if necessary. Thanks for watching, and don't forget to subscribe to Stock Wisely for more informative videos about the stock market.